Hello, how are you guys? I hope you're all good. So today in this video we'll be looking at a specific structure, specific pattern which I was supposed to do the video last week but I had no time, so I'm going to do it we're going to look at it today. So in this pattern, normally let's say we have a resistance down here. The market will come down as if it's forming a reversal structure like this one here. And then on the last part, it will form a pattern as if it's about to go up and reverse back down, but it normally reverses and impulse up. As you can see this part here, it looks like a reversal structure to go back down, but it doesn't move down, it goes back up. This on a bearish market as it's about to reverse to become bullish. On a bullish market, it's normally the same, just the opposite of the bearish market. Here, the market was coming from down, and then it started forming a reversal pattern, and then on the last part, it moves down correctively as if it's forming a reversal pattern to go back up, but it doesn't go back up. It just reverses and moves down. So we are going to the part that we are going to be concentrating on is this last pattern here. And this specific pattern, they normally occur going to the mostly they occur going to the downside. So I will concentrate more with the downside part. They don't mostly occur going up. So I will concentrate with the reversal from bullish to bearish because that's where they mostly occur. So on this part here, as you can see, this last part, the market will come, see it touch the structure three times, one, two, and three, and then it will start moving down correctly. And then on the last part, the market will start moving up correctively. If it were to go back up, it will move up impulsively, forming smaller corrections. But here in this specific structure, it normally moves back up correctively, and then it impulse back down, break the lows, and it reverses. Sometimes it reaches to the trend line up here, and sometimes it might break the trend line just a little, like here. It starts move down. It normally starts moving down correctively, and then on the last part, when you are expecting it to move back up, to impulse back up to these highs, it start moving up correctively. It might break that trend line, and you might think it has broken the trend line, it's going back up. And most of the time it will form a structure where you can draw your trend lines. You can enter on the break of the trend line like this, and this one right here. With this, it depends with the entry style. It depends with the stop loss. If the stop loss is too big, and if you manage to get a risk entry from up here around these areas, you can enter from there. And we saw this one, it sometimes breaks the trend line and then reverses back down, and sometimes it doesn't even get to the trend line. It will come down, give you the first touch, second touch, or even maybe the third touch, and then start moving up correctively instead of impulsing up from the trend line and forming smaller corrections. If it does something like this, you will definitely know that the market is changing direction. It has reversed. It's no longer bearish. It's no longer going down. It's going to be going up. So on this, you can enter from here. They are not the most common, it's not the most common structure, but they are very profitable. So we look at them in the market, real market. So we'll go down to the market. So the first pair The first example that you're going to be looking at is on Swiss franc. On this pair, Swiss franc, Japanese yen. As you can see, this on 4-hour time frame, you can see the market was forming a reversal pattern. This rising channel, and the market had touched this channel the first time, second time, and we are waiting for the market to reverse from up here, but it never got to the that touch. It reverses, and then from here it started forming a pattern. From this pattern, since the market was going up, you might think that because this looks like a reversal pattern to go back to the highs. You might think that the market will go back up, but it didn't go up. On the last bit, we normally concentrate on this last part. It started going up corrective. And if you go down to the 1-hour time frame, you can see that this is a reversal to go back down. It touched this channel first time, second time, third time. On the fourth time, it broke the channel up a little. It broke up. It reached on this last part where it touched the channel the fourth time impulsively, so you couldn't enter with a risk entry from up there. So it started forming a reversal structure up there. If you go down to the 15 minutes, you can see it clear. It started forming a reversal structure up there, and then it impulsed down and then formed a correction. And from this correction here, you could have entered with your stop loss just above the structure, around 35 pips, let's say 40 to be on the safe side, and the market impulsed down. It impulsed down and then corrected back up a little. It would have stopped you out, depends with your broker and the spreads. It would have stopped you out if it didn't stop you out. You see, it got to the low of it got to the beginning of the correction. Guys, these specific patterns are very profitable, but they are not the most common. So we look at the next example, which is on New Zealand dollar, Japanese yen. On New Zealand dollar, Japanese yen, if we go up to the higher time frame, we'll see that New Zealand dollar, it was forming a structure. It was moving correctively to the that touch. It had formed a reversal structure. It touched this specific trend line the first time, second time, and it approached the trend line on the that time correctively in a pattern. This is a pattern within a pattern. So if we go down to the 1-hour time frame, that's where we got our entry. You can see this pattern. It was touched by the market first time, second time. On the that touch, the market moved up there correctively, and it reversed back down, and then it started forming some sort of a correction, which looks like a reversal pattern to go back up to the to go back up to this trend line for another touch before reversing back down. But on the last bit, which I've said that it's normally the bit that we concentrate on, it was forming a correction going to the trend line. See, the trend line was touched first time, first touch, second touch. On the third touch, it moved to that trend line correctively, which you could have entered on the break of the trend line and put your stop loss just above the structure, maybe 45 pips to be on the safe side. And this was news. This big red candle, this big bearish candle, this was due to news. After the news came out, the market just impulsed down, and it didn't take long before the market got to the beginning of the correction, which are normally our profit targets. And after that, you saw it's corrected, and now it's forming another correction. Don't worry about this. This is a trade that I've entered this week. I was stopped out at break even. We'll go to the next example, which is on the DXY. This is the dollar index. We'll go to the 4-hour time frame. You can see In this pair, the XY, the market was approaching this trend line up here, which is a structure on the weekly time frame. It was approaching it in form of a structure which is a reversal structure, and when it got there, it started moving down correctively instead of impulsing, forming smaller correction, impulse, smaller correction. It started moving down correctively. And on this specific one, it didn't get to the trend line for the third touch. It moved down correctively, and then on the last part, the last bit which we concentrate on, it broke the trend line and it impulse down, forming impulse and correction, impulse correction, and now we are down here. You see, it's almost there, a few pips to get to the beginning of this correction. So if you had entered from here, we'll go down to the 1 hour time frame. If you have entered from like this one, you would have entered. You couldn't have entered with a risk entry because it got to the that touch impulsively. You would have waited for the market to move to impulse down. If you go down to the 15 minutes, you see that this is an impulse. This is an impulse, and then a smaller correction, which you would have used to enter after the break of the correction. If you would have entered from there after this break of this correction, you will have taken the market down. The market will have gone down with you up to this area where it form a bigger correction. Maybe it would have stopped you out if you were patient enough. You will still be on this trade, or you would have taken the market down to around here where the market would have stopped you. So we'll look at the last example, which is on the Australian dollar against the New Zealand dollar. There's a trade which had taken here last week. You can go back to the videos. It's on trade recaps for the, the week before last week. I taken a trade here. As you can see, it had formed such a structure, just something like that up here. From up here, the market reversed from up here, and then it started going down correctively. If you are not keen enough, you would have thought that the market was going to reverse to go back up again for another touch on this trend line here. But it moved correctively, it moved up correctively, broke the broke that structure, and it went down. If you go up to the 4 hour time frame, you can see that it was impulsing, correcting, impulse correction, impulse correction, the way the market moves. And to me here, if you go down to the 1 hour time frame, we will remove these trend lines. I'll just hide them. And the market was around here. Yes, see exactly here. To me, this looked like a reversal structure to go back down, a continuation structure to go back down, to continue to the market to continue going down, being bearish. When it got to this that touch, it got there impulsively, so I couldn't enter with a risk entry, and the market started moving down corrective, and I had this structure right here. You can see the market touch down here two times, and it had touch here, first touch, second touch, and it was approaching the third touch corrective. So I took the trade on the break of this smaller structure here. If you go down to the 15 minutes, you'll see that this is a smaller structure. I took the trade on the break of that structure. My stop loss was just above that structure. Let's say that 5 pips. And I was almost taken out, but I was patient enough. The market impulsed down a little, and after that, I noticed that the market was forming a continuation structure to go back up, and I moved my stop loss to break even. I was taken out on break even on this specific trade, but if I had not moved my stop loss to break even, I would have taken a 1% loss, which I would have been okay with it, because you'll never win all the trades that you take. So guys, that has been our video for today. And whenever you're taking this trade, these reversal structures, this specific pattern, make sure that it is in alignment with the higher time frame, structure. Like on this specific trade, as you can see, the market on the daily time frame, we saw that the market was about to reverse. It had already reversed to go back down, and this was just a correction, the first correction after the impulse down. So you just don't take them in the middle, from the middle of nowhere. And as you can see here, the market is forming same structure just like this. So this is something that I'll be watching. This structure here look exactly just like, not exactly, but something like this one. And whenever you see a pattern that is a replica of a similar pattern that has just repeated itself, it has a high probability of playing out. So on this one, I'll be watching it. I'm still watching it. That's why I have this trend line here. If it breaks this trend line, it will be a signal that the market will be moving down to around these areas. Another thing to note, guys, is that sometimes it will break that trend line, reach down here to the beginning of that correction. I'll just show you right now. It might break this trend line, go up, break this trend line, reach to the beginning of this correction down here, and then it reverses and goes back up. So whenever you take these trades, when it gets back down to the beginning of the correction, make sure that you have already moved your stop loss to break even, or you have taken partial profits, because the market might get down here and then it impulse back up and it take you out with a loss, and you are already in profits, which might affect you emotionally, and then you start trading with emotions, which is not good. It will affect your psychology. And another thing to notice, the key thing with these channels that you'll be looking at is to ask yourself, what do we have at the end of the pattern? What do we have at the end of this pattern? Because all this is a pattern which look like a reversal pattern to move back up, but as you can see, the at the end we had another pattern which is a reversal pattern to go back down. So if the market as I have said, if the market was to go back up, it would have impulsed and start forming smaller correction while going up. But with this pattern, it normally go up correctively. So guys, that has been our video for today. Please like, subscribe, and recommend others to these videos. Thank you for watching. Until next time, have a good morning, day, or evening, night, wherever you are. Thank you.